So, Kate, do you have a speaker for me?
Yeah, we've got Jeff Tompkins.
Hey, Jeff, how you doing?
Good morning. I'm well.
How are things in sunny LA? Did it get 100 yesterday?
Oh, I'm actually in Boise.
Boise, you flew the coop.
Yeah, I'm actually an old Bay Area native. So I haven't been down. I've been down to Southern California. I haven't lived down there, but used to live in the Bay Area, and I flew the coop, and I'm in Boise.
Well, if this stock market thing doesn't work out for you, there's always a future in logging as long as you're in Boise, Idaho.
Logging and DRAM chips, micro.
Yeah, and working for Micron Technology.
Yeah, yeah, exactly. One of my
So,
favorite stocks.
me too. So go ahead and get your PowerPoint up. Jeff Tompkins is a professional stock options and futures trader, has a BS in finance from Santa Clara University, and over 20 years of experience trading the markets. Jeff also serves as hedge fund manager at Altos Capital. Jeff's successful career led him to create Altos Trading LLC in order to help others achieve financial freedom through consistent and profitable trading strategies. Altos trading philosophy is to give students the best learning experience without any fluff, complicated techniques, or unnecessary software. All students and alert service subscribers receive a direct path to success with clear instructions that drastically reduce the learning curve to profitability. Okay, Jeff, you know how it works. You have until 5 minutes before the hour when we start handing out our prizes again. I'm going to go ahead and mute myself, and you have the floor.
Excellent. Well, thanks for having me. It's a pleasure to be here. Welcome to all of you. It's great to see a nice crowd here, and at least for me, early in the morning. I see we have some people from Australia and all over the world. So great to see everybody here. Today, we'll talk about how to fix losing options trades. So if you're an options trader, this is right up your alley. One of our core methodologies at Altos is adjusting trades, option trades, trades that aren't working out in the way that we initially intend them to. So we're going to go over some of the more popular option strategies out there and what to do when things go wrong. Before we do that, I'll read a quick disclaimer. Trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options, and of course need a broker to trade securities and must meet suitability requirements. We'll be going over some various results on our session today. Most of the results I share are going to be real world, real money results, but just know that any results that I do share are not necessarily indicative of future performance. And again, they might be based on actual trades, real money results, but of course, due to the time critical nature of trading, brokerage fees, activity of other traders, we don't guarantee that anyone will mirror the performance of what I share on the session today. So let's start out with a little icebreaker. Get your chat box pulled up and ready. I want to see if anyone has any idea what these two products have in common. This might seem a little bit strange and not related to trading, but you'll quickly see that it is related to the business of trading. So anyone have any idea what these two common household products have in common? WD-40 and the Nintendo gaming system. It's tricky. I'll give you that. And if you don't get it, I'll tell you what it is, but I'm just curious to see if anyone has any idea what these two things have in common. Yeah, we already got a correct answer. Uh, Good job, PD. You got it. So PD, you win the prize. You got the correct answer. And that is that both of these products actually failed miserably early in their product life cycles. So let's look at Nintendo. Of course, we know it now as the gaming company that launched an era. It actually didn't start out an era in home gaming, but didn't start out that way. It didn't start out successfully. In fact, their first offering, which was the Famicom console, had to be recalled after only a few months. And then Atari came along in the mid-'80s. They left the whole American video game industry in a mess. Nintendo addressed that by launching the NES, which then barely sold in the mid-'80s. Of course, now they're very successful. And so how did they do that? Well, they made a critical adjustment to their business model, and they introduced these two little guys you see on the screen there, Mario and Luigi. And that changed the entire history of American gaming forever and really turned their whole business around from a failure into a major success. And when you look at WD-40, if you've ever wondered how the lubricant got its name, it comes from the fact that the formula represents the 40th attempt to create a degreaser and rust protection solvent. So they actually failed 39 times. It was originally used in the aerospace industry, but they had a lot of trouble formulated into an aerosol product that could be used at home. Okay, so they made 39 or 40 different adjustments to the model, but 39 until they were actually successful. So imagine had they given up after 39 tries, we might not have WD-40 as we know it today. So the takeaway from this is that virtually every business faces hurdles, challenges, and even failures. And ultimately, what leads to success is the ability to make adjustments to their business model, their product offering. And so this is where that theme ties into the world of options trading. If you've ever traded options, you know that just like with any other strategy, we encounter hurdles. Market conditions change. Things don't always go as planned. So it's critical that we have adjustment techniques in our toolbox to make adjustments to trades when things don't go as planned. And when you look at why very few traders make it, there are, of course, a lot of causes of failure. But when we look at this as a trading business, it's ultimately the losing trades that wipe out profits from our winning trades that result in the low success rate. So looking at this as a business, this is what our biggest overhead is our losing trades. Now, the good news is, in my experience, up to 75% of the losses that I was previously experiencing in my options trades were fixable and avoidable, meaning that I could mitigate a loss, maybe turn it into a break-even scenario, even turn it into a net profitable outcome. Okay, just using some basic adjustment techniques. So there are always going to be losses. There are costs of doing business in the trading world. But a lot of these can be avoided and even turn into profitable trades by making a few simple tweaks. And that's what we're going to focus on in our session today. So imagine if you could take a popular option strategy like the Iron Condor, and let's say you'd set an Iron Condor up on the S&P 500 index. It's not going as planned. Let's say it's down $3,900 on a 10 lot. So you have a couple choices. You could take that loss, move on to the next trade, or perhaps make a couple tweaks to that trade that's not working out and turn it into a $2,400 winner. How about another popular option strategy like the credit spread? Let's say you set up a credit spread on the Qs. Again, it's not going as planned. It's down $580 on a 10 lot, but you're able to make a couple adjustments to the trade and turn it into a $620 winner. Or how about a naked put? Another strategy that we'll take a look at. Let's say that you've sold put premium on Ciena, CIEN. Again, it's not going as planned. You're down $730 on a 10 lot. You could take that loss and move on to the next trade, or you could make a couple tweaks to the position and turn it into a $540 winner. Well, these are not hypotheticals. These are actual real world examples where we've incorporated these different option strategies and specific trades that didn't go as planned initially, but we were able to make some simple tweaks to these positions and turn them into net profitable outcomes. So I'm going to be walking through each of these strategies and how we accomplish this using trade adjustments. And anything that I share on my educational sessions, I, whenever possible, strive to back up with real world and real money results. So I'm going to go ahead and do that. This is a screenshot of my personal TD Ameritrade Thinkorswim account, which is of course now Schwab, from back on August 24th, 2015. So going back almost 9 years ago, I had this portfolio of short put positions. So I had a dozen or so short puts. And on this particular day, if you were in the markets back then, you'll recall was the flash crash of August 2015. All right. Now, if you're familiar with selling put premium, and even if you're not, we'll get into it and I'll elaborate on the mechanics. But when you sell put premium, you're collecting a credit into your brokerage account, and it's a neutral or bullish strategy. So ideally, you want the underlying stock or ETF or whatever you're selling the put premium on to either go up, remain flat, or it can go down a little bit. What you do not want to have happen is a significant drop in the underlying asset. Okay. And of course, you can see on August 24th, 2015, that's exactly what happened. There was this major flash crash. And if you look at the percent change column in my Thinkorswim account, every single underline is down significant percentages, some double-digit percentages, 12, 10, 14%. But every single underlying asset is down, which is what you do not want to have happen when you sold put premium. Okay, but if you look at my P&L, and I live in the Mountain Time Zone, so this was taken 6 minutes into the open. So markets have been open for 6 minutes. Okay, I should have a significant negative P&L in the midst of this flash crash. However, my P&L is positive $7,609.92. So how is it that I have this portfolio short put premium that should be showing a negative P&L 6 minutes in the open in the midst of the flash crash, but I have a P&L of over $7,600? Well, I did this with a very specific trade adjustment. So we're going to come back to this, and I'm going to show you exactly how I did this, and I'm going to give you the formula. So I just want to show you that these adjustment strategies are ones that I do use in real world trading. Okay. And there's actually an adjustment to fix virtually every bad options trade. That's one of the beauties of options. They're a flexible asset class that allow us the ability to make adjustments in ways that we can't necessarily do with individual equities or futures contracts or Forex pairs. So it's a really, really unique market that gives us that flexibility. And over the next hour or so, I'm going to reveal a few of my most effective adjustment techniques to fix losing options trades. So we'll look at, for example, taking a losing credit spread and executing a delta neutral hedge and transforming it into a net winner, or a losing short put or naked put, as they're referred to, executing a horizontal roll and turning it into a net winner. And as I mentioned, you can really do this with virtually any strategy, even single leg option strategies like long calls and long puts, where, for instance, you could take a losing long call, execute a vertical spread, and turn it into a potential net winner. And sometimes these have to be done in multiple steps. Sometimes they can be done in one step. So we'll look at some different examples of where we might need to, use a couple adjustments, and others where maybe we just need to use a single adjustment. So before I do that, I'll give you a quick background on myself. Again, I'm Jeff Tompkins. Great to have you guys here today. I'm the Chief Investment Strategist of Altos Trading. I have over 2 decades of experience trading the equities, ETF, options, and futures markets. Received my professional training at Morgan Stanley as an intern at the trade desk back in the early 2000s. Founded Altos Trading about 9 years ago. We currently have over 60,000 members in over 100 countries across the globe. As John mentioned, I'm also a hedge fund manager, so I do manage money for my clients at Altos Capital. And a lot of what I share in our session today are strategies, tactics, methodologies that I deploy in my hedge fund. So this is a unique opportunity to get an inside look into the mind of a hedge fund manager and how I operate, and have been able to have positive years every year since I've launched my hedge fund. I'm also the founder and manager of some of the top performing options alert services on the market today, which I'll talk to you a little bit about as well. So by the end of our session, you're going to discover how to fix losing options trades and even turn them into winning trades. So we can't fix every single trade, but we can, again, mitigate a loss, potentially turn it into a break-even scenario, or even a net profitable outcome. So I'm going to reveal some of my top trade adjustment tricks to reduce risk and increase potential profits. So whether you're just starting out or you're a seasoned veteran, this is really must-have information for today's markets. So let's talk about, as we get into the option strategy here, selling options versus buying options. When we have new members come to us at Altos, this is often one of the first questions that we encounter from our members. Is it better to sell options or is it better to buy options? Well, that's a bit of a subjective question. I wouldn't say that inherently one is better than the other for any individual person. But if we look at it more objectively, there's better statistical odds typically for, when done correctly, selling premium versus buying premium. And if you look at just the pure statistics of it, option selling actually can have better statistical odds than a casino has over its customers. And that's exciting because we know that casinos have a built-in statistical edge that will guarantee them to make money over time, over the long run. Now, any given day, they could have, a whale walk through the doors and get lucky and wipe them out. And that's analogous to trading. We can have a bad trading day where we see, previous profits that we've earned evaporate through losing trades. Okay. But as long as we have a positive expectancy, meaning that the statistical formula tells us that when we factor in losing positions, winning positions, win rate, and the ratio of our winning trades to our losing trades in terms of magnitude, we'll make money over time. We just have to stay in the game. Okay. And that can be difficult to do with options. We have a better chance of doing that by option selling versus option buying, but it still doesn't guarantee a positive expectancy over the long run. So what does? Well, in my opinion, that is the ability to adjust trades that aren't working out. Now with premium selling, if we look at that relative to premium buying, so that would be like buying a long call, buying a long put. Okay, we have premium selling gives us essentially three ways to win. Okay, so if we have a bullish premium selling strategy, the stock can go up, the stock can stay flat, or it can move down slightly, and we can still make money. Okay, but that's not the case if you buy a long call, or if you buy a long put, or even if you just buy a stock, right? If you buy a stock and that stock stays flat, you don't make money and you don't lose money. If it goes up, you can make money. If it goes down, you lose money. So out of those three potential outcomes, you only have one way to really make money. Premium selling gives us the opportunity to make money in all three of those scenarios. And it allows time decay to work in our favor, what we call theta. We'll be talking about that as well. There's also typically more room for error with premium selling. So we don't necessarily have to be exactly right on our timing, our directional forecast, etc. It's also typically easier to adjust short premium or premium selling strategies. Okay, and we'll get into that more as well. So let's start looking at some popular premium selling strategies. One of my favorites is selling puts for income. Okay, so a naked put or a short put is when you sell to open put options. So like any other market, there's a seller and there's a buyer. Okay, so when somebody buys a put because they anticipate the underlying asset to go lower, somebody needs to sell them that put. Okay, and that's where you come in as a premium seller. And you collect a credit in your brokerage account for entering that trade. Okay, so the premium of the put buyer is paying is being deposited into your account as the put seller. And when the stock rises and the put options that you sold expire out of the money, you get to keep the entire premium you collected when you sold those contracts to the put buyer. So here's just a generic example. Let's say ABC stock's trading at $100 a share. You sell to open 10 contracts at the 95 strike for $250 a contract. Let's say these expire 2 weeks out. Since each contract controls 100 shares of stock, you receive an immediate deposit of $2,500 into your brokerage account when you put on the trade, less any brokerage commissions and fees. Now, as long as ABC stock closes above $95, that's our strike price, at the expiration, you keep the entire $2,500 premium you received when you initiated the trade. Sounds pretty great. And when it works out, that it's fantastic. But like any other strategy, it doesn't play out that way 100% of the time. In our experience, and the way that we sell put premium, it does play out that way a high percentage of the time, anywhere from 85 to 95% of the time. But what about that, 5 to 15% of the time where things don't go as planned? That's where adjustments come in. And we're going to get into that momentarily. But let's kind of dispel some common misconceptions with put selling. There's this common misconception that selling naked puts is extremely risky. Like any other strategy, that can be true if it's mismanaged. If you don't use good risk management, appropriate capital allocation relative to your account size, etc., of course, it can be very risky. There's always the potential to over leverage if you're trading with margin, which a lot of people do when they sell put premium. But there's something called cash secured puts, where you only sell put premium based on the cash that you have available in your account to cover that position. So it largely depends on how it's managed. But if you look at the option risk graph of a short put, it actually has similar, even identical risk profile to buying stock or writing covered calls. Now, if you ask somebody who is familiar with options trading, is a covered call strategy a risky option strategy? They'll almost all tell you no, it's not. And they think that because they own the underlying shares of stock and they're writing call premium against those shares. So we're kind of taking out the margin or over leverage component. Doesn't mean you can't over leverage that in a covered call strategy. But the risk profiles are the same, okay, between writing a covered call and selling a put. Interestingly, brokers treat short puts as a more risky strategy by requiring a higher level of option trading approval, okay? And really the reason they do this is they realize that they're kind of like, it's kind of a funny scenario because they are extending the potential to trade these on margin to over leverage yourself, and then yet telling you that it's risky. So they're giving you the ability to mistreat or mismanage or use leverage and unnecessary risk. But then they're telling you that, okay, we'll allow you to do this, but we're also going to raise the level of option approval required to trade the strategy. Well, it's kind of funny. They don't do that with a covered call strategy where you can lose just the same amount of money based on the same underlying movement or movement in the underlying asset, right? So this is where it becomes critical to, number one, use good risk management, don't over leverage, and really look at the risk graph. What is your actual risk exposure? Because when we do this correctly, with good risk management, it can actually be extremely consistent and profitable when it comes to collecting income from the options market. Okay, so I'm going to walk you through kind of some of the ways that we do this, but it's actually how Warren Buffett often acquires stock at times. So he'll sell put premium in Berkshire, his company, and acquire stock at a lower cost basis. Now, for our purposes, when we sell put premium, our intention is not to acquire shares of the underlying stock. That's certainly a viable strategy for some people, but our purpose is purely to collect the premium and hang on to it by the time expiration rolls around. Okay, so that again happens most of the time, but what happens when things go wrong? So with any trade that I put on or that we do with our members at Altos, we always have a primary exit strategy. In the case of put selling, this is where that put would expire out of the money. We keep 100% of the premium collected. Okay, and again, at a minimum, that occurs 85% of the time, so it's a high percentage of the time. In reality, going back hundreds and hundreds of trade examples that we've done with our members at Altos, going back to like 2015, so 9 years. Historically, this has actually happened more like 90 to 95% of the time. Okay. Option statistics tell us that it should happen the way that, the deltas that we sell put premium should happen about 85% of the time. But we have some additional edge that we built in here on the technical analysis side. Okay. So we're able to be successful about 90 to 95% of the time right off the bat. But that still leaves a small percentage of time where things can go wrong. Okay. And this is where a secondary exit strategy comes in. So this is where we would need to make an adjustment to a trade that's not working out as we anticipated. And in fact, one of our favorite adjustment strategies often results in even greater profits. So this is where things kind of become counterintuitive. Most of the time when we encounter a difficulty in life, or specifically in trading, we may be able to do something to help mitigate that difficulty or a negative outcome. But often a bad scenario can quickly become a worse scenario. So we can go from bad to worse pretty quickly. And for anybody who's traded knows that that's a real possibility. So it's counterintuitive to think if something goes wrong, we could actually end up better off than had nothing gone wrong to begin with. Okay, and this is where it gets really exciting with trade adjustments. So I'm going to walk you through some real world examples of scenarios just like this. But that's our secondary exit strategy. So now let's look at some different ways to adjust a losing short put. All right, we're going to look at two different strategies. One is rolling. All right, so rolling involves closing out our initial trade, that's our short puts, and opening a new trader to further out expiration. And we'll typically do this at the same strike price and the same number of contracts. Okay, so we're not looking to increase our exposure, our capital exposure, our risk exposure by increasing the number of contracts. We're not necessarily looking to change the strike price. that would be referred to as rolling up or rolling down, which is a vertical roll. Occasionally we'll do this, but most of the time it's not necessary. Okay. And we're going to walk through some examples so understand how to do this. Okay, so rolling is one we're going to look at. And actually this one adjustment technique and it's now over 350. I need to update this slide. I think we're somewhere around 380 now. Over the past 8 years, we have over 350 net winning premium selling or short put positions that we've done with our members at Altos with 0 net losses. And we currently have 2 positions in adjustment. Okay, so I think it's somewhere around 380. Let's just say 380. So 378 out of 380 we've closed as net winning positions with 2 currently in adjustment. Okay, using this one adjustment. That's an incredible track record that is very, very difficult to come by. But again, I'm going to show you how we've accomplished this. Another adjustment technique that we use is delta neutral hedging. This is a little bit more complex, but again, I'll walk you through it and I'll give you the formula here momentarily. But basically, in order to transform a naked put into a delta neutral position, what we do is we buy to open enough at the money or near the money put options to offset. And sometimes, we want to try to, it's called delta neutral because we want to neutralize the delta, get it close to 0. We can't always get it perfectly 0. So as completely as possible, we want to offset the positive delta of the existing short put options. When we execute this adjustment, if the stock continues to fall, and again, when we sell put premium, that's what we don't want to have happen. We don't want the stock to fall significantly. We can actually profit on the put options that we purchase and offset the losses on the ones that we sold if the stock continues to move lower. And we'll typically use this adjustment if the short puts move in the money aggressively. And I'll be elaborating more on the circumstances of when would we use each adjustment. But those are the 2 we're going to look at. So let's start up by looking at delta neutral hedging. I told you we'd come back to my Thinkorswim account from back in August of 2015 during the flash crash. Okay, so I've got this portfolio of short put positions. Every single one of them is down significant percentages in the midst of this flash crash. Okay, and remember, this is what we don't want to have occur when I've sold put premium on these underlying stocks and ETFs. Okay, so how did I have a P&L of over $7,600 6 minutes in the open when the market's crashing, and I have a dozen or so short put positions? I accomplished this using delta neutral hedging. Okay, and I'm going to give you the formula. Okay, and then we'll walk through kind of a generic example. Most of this you won't have to actually calculate. Your broker platform will provide this to you, like the position delta, but just for purposes of understanding. Okay, so that's the first thing we want to identify is what is our position delta. To do that, we take the number of contracts and multiply it by the delta times 100. Okay, that's going to give us our position delta. Now, the next step is to divide the at the money option delta. So that's going to be the strike price that is closest to the underlying asset price. And we want to divide that at the money delta by the position delta, and that will give us the number of contracts to buy. And the result is a delta neutral hedge that can profit on a continuing decline in the underlying security. So here's just the generic example of an options chain. Okay, we're on the put side of the chain, and let's say we had sold the 58 strike puts. And if you're familiar with an options chain, you can see those have moved in the money, which means that the underlying stock has dropped below our 58 strike. And that's what we do not want to have happen when we sell put premium. Okay, so this is a scenario where we'd be facing a potential floating loss in the position. So how would we delta neutral hedge this? All right, well, we're going to take the delta of our existing short put position. And by the way, we're not even going to touch the losing position. We're going to leave it alone. Okay, that is a delta of 0.59. You can ignore the negative, right? Puts have a negative delta. Just look at the number. Okay, we're going to plug that into the formula. Let's say for example purposes, we're going to trade 10 contracts. So if we sell 1058 strike contracts, we're going to have a position delta of 590. Okay, how would we neutralize this delta? Because right now we've got a 590 delta, and if the stock continues to drop, we're going to experience losses in the position. What we can do is take the at the money strike price, in this case 57, that's the strike price that's trading closest to the underlying share price, divide it into our position delta, and it's going to spit out a number. In this case, that's 12.29. Now, of course, we can't buy 12.29 contracts, so we'll round up or down to the nearest whole number. So in this case, we round down to 12. And that tells us that we need to buy 12 57 strike contracts to neutralize the delta and our 10 lot position at the 58 strike. Okay. So we leave that alone. We still hold the short 10 lot position at the 58 strike. But then we buy 12 contracts at the 57 strike to neutralize our delta. And if the underlying stock continues to fall, those 12 57 strike contracts can actually produce a profit that outpaces the loss in the short put position. And this is exactly what I did back on August 24th, 2015 during the flash crash. I delta hedged all of my short put positions, and because of the magnitude of the crash, my P&L was positive over $7,600 6 minutes into the open. Okay, so this is an example of delta neutral hedging. Now let's look at rolling. Okay, so this is the primary adjustment technique we use in our put selling service that we do with our members at Altos. Okay, let's look at a real world example. This one's from back in 2019. Again, we don't have to do these very often, but this is one we did about 5 years ago, 4.5 years ago, September 12th, 2019, on Micron. Okay, again, company based right out of where I live. We had alerted our members to sell put premium on Micron with a September week 4 expiration at the 44.50 strike. And that could be done at the time for 55 a contract. So for all these examples, we'll just use a 10 lot or 10 contracts. Okay, so if you sold 10 contracts at the 44.50 strike going out just a couple of weeks, you'd collect $550 less than any brokerage commissions or fees. Okay, and as long as Micron finishes above 44.50 at the September week 4 expiration, you would keep that entire premium that was deposited in your account. That's not what happened in this scenario. Micron actually sold off and was trading well below 44.50. So what we did is on September 27th is roll those contracts out for a $1.19 debit. And we just went out a couple weeks to the October week 2 expiration. We stuck with the same strike price, 44.50. So we didn't change the strike price. There's no need to change the number of contracts that you initially traded. Okay, we're just closing out the position that's not working out and we're rolling it out. But something critical is happening here. Notice how on September 27th, when we close the position out that's not working out, we're debited $1.19. Okay. When we extend the expiration cycle, we're credited $2.16. And this is what we call staying net cash positive. Now, the reason this is possible is due to changes in implied volatility. Okay, so the further out in expiration you go, typically the more expensive the premium gets. Now, that's detrimental to an option buyer, but as an option seller, and particularly when we're rolling and making an adjustment, it's beneficial. So we're actually rolling for a net credit. All right. And what that means, the implications of that is that the underlying we just really need implied volatility to come back down. The underlying stock doesn't necessarily have to return back above the strike price. As long as the sell-off stabilizes, which is inevitable unless the stock drops to zero, then implied volatility will eventually come back down, which will decay the premium, which in turn works in the favor of the option seller. And in this particular case, on October 11th, this position could be closed for a 52-cent debit. Okay. Now, if you go back and look at a chart of Micron, what's really cool here, the stock never returned back above the 44.50 strike. Okay, that was our strike price initially, and it was the strike price when we rolled the position. In fact, it was sitting at 43.59 when the position was closed, almost a whole dollar below our strike price. But because the stock sell-off stabilized and implied volatility came down, it decayed the premium, and because of the rolling adjustment was done for a net credit, the net outcome on a 10 lot was an $820 profit potential. So here's the critical thing to notice here. Back on September 12th, when the initial trade could be put on, and again, we're using 10 contracts as an example. The maximum profit potential, had nothing gone wrong, if everything just worked out as planned and Micron stayed above 44.50, was $550, less any brokerage commissions and fees. However, we encountered a bit of a hurdle because Micron sold off below the 44.50 strike. We made a single adjustment, one rolling adjustment to the position, and came out with a net potential profit of $820 per 10 lot. Better than had nothing gone wrong to begin with. Okay, this is the counterintuitive nature of a lot of the adjustments that we do. And the reason, again, that works is because it allows us to stay net cash positive while taking advantage of decreases in implied volatility and increases in the underlying share price. And again, that increase doesn't necessarily have to be back above the strike price. Okay, so again, real world example of rolling. And as I mentioned, the silver lining here, while often we do recover back above the strike price of our short put position, we don't necessarily have to do that in order to be profitable. As long as we're staying net cash positive with the rolling adjustments, the net credits over time can offset the debits. Okay, so that's rolling as it relates to put selling. Let's look at a couple other popular strategies: credit spreads and iron condors. Okay, I used to trade credit spreads early on in my option trading career and thought they were the best thing in the world until I realized that they have an inverse risk reward skew, and one bad trade can wipe out, 10 to 12 successful trades. And I quickly became to despise them until I discovered trade adjustments. Okay, so we'll get into that. But if you're not familiar with the strategy, they're a popular option strategy created by buying cheaper option contracts, simultaneously writing an equal number of more expensive option contracts. So this is what we call a vertical spread. And we receive a credit or a cash deposit into the account for executing the trade, similar to when we sell put premium. And that's why we call them credit spreads. Now, an iron condor is simply the combination of two credit spreads. It's the same expiration, same number of contracts. It combines a bull put credit spread and a bear call credit spread on the same underlying security. Okay, so this is more of a market neutral strategy. If we think that the underlying asset's going to stay in a specific trading range through expiration, an iron condor might be an appropriate strategy. But again, like any other strategy, things cannot go as planned. Okay, so why do I now love iron condors and credit spreads? Well, first of all, if you compare them to a long option strategy like buying a long call or a long put, where you have to hit a bullseye. Okay, you've got to be right on your delta, gamma, theta, vega. In other words, your timing, your direction, your premium decay. All of those things have to line up correctly to be successful. And that's very difficult to do. So you've got to hit a bullseye. When we sell credit spreads and iron condors, we can really throw darts all over the dartboard and still be right. But that doesn't mean we can have a positive expectancy and be profitable over the long run. It just means it's easier off the bat to achieve more consistency. In terms of the long-term profit potential, or what we call positive expectancy, that becomes very difficult with credit spreads and iron condors without adjustments. So if you don't know how to adjust these when things go wrong, you can face scenarios like I mentioned earlier in my options trading career, where I thought this was an incredibly consistent and profitable strategy until I encountered a bad trade. Okay, so this is where trade adjustments come in. So let's look at how to adjust a losing credit spread or iron condor. We're going to go back to delta neutral hedging. So delta neutral hedging can be applied to virtually any option strategy. It's just done a little bit differently based on what that strategy is. So with the credit spread or iron condor, in order to transform one of these strategies into a delta neutral position, and this is just kind of a quick and dirty way to do it without running the calculations. If either our short put or short call strike is breached, we would close half the contracts at the breach strike. So and we'll walk through an example without doing the calculation. But you can also use that formula that I gave you previously and calculate your position delta, and then determine how many contracts at the short strike you need to exit to neutralize your delta. Again, your broker platform will help you with that. It will do that calculation for you. But delta neutral hedging can actually produce winning trades with a profit greater than the initial credit. So just similar to rolling, like we just looked at. Let's look at an example. Okay, this is again a real world example we did in a prior year with our members at Altos on the S&P 500 index, the SPX. So on June 15th, we set up a June week 5 expiration iron condor, which could be done at the time for 110 a contract. All right. Now, in this case, again, things didn't go as planned. So the S&P actually sold off significantly. 10 days later, it breached the 27.25 strike puts, leaving a potential $3,900 loss on a 10 lot. Okay, so if you sold 10 contracts, you'd be looking at a potential $3,900 loss. If you sold one contract, $390, right? Now, again, we can accept that loss and move on. Okay, there's nothing really spectacular or out of the ordinary that occurred here. This is a common thing that we would face when we sell, spreads, and move on to the next trade. But the other option is to adjust that, and that's what we did in this scenario with a delta neutral hedge. So the very next day, June 26, we alerted our members to adjust using a delta neutral hedge by closing half of the 27.25 strike puts to neutralize the delta because we anticipated the S&P to continue to sell off, which is what occurred. And on June 27th, the iron condor could be closed for a $240 per contract profit, turning a potential $3,900 loss in a 10 lot into a potential profit of $2,400 for every 10 contracts traded. Once again, let's imagine that nothing had gone wrong to begin with, and the S&P just stayed right in between our short put and short call strikes between June 15th when we put the position on and the June week 5 expiration. Our maximum profit potential was $1,100 on a 10 lot. Okay, had nothing gone wrong. In this case, we encountered a hurdle. We made an adjustment, just one single adjustment, and ended up with a potential net profitable outcome of $2,400, more than twice what the profit potential was on this individual trade had nothing gone wrong to begin with. Okay. So delta neutral hedging can really work magic when the underlying continues to move in the direction of your breach vertical credit spread. So this is an adjustment technique that we would use in the event of, a significant directional move that we anticipate will continue. So, if you set up a spread, at critical support and resistance levels, and one of those levels just is blown through, it may make sense to use a delta neutral hedge. I'm just looking at time here. I'm a little short on time, so I'm actually going to skip through this Apple example. Happy to provide the slides to you guys if you want them. I'll give you our contact information here at the end, and we can send you out the slides. But I'm running a little bit behind here, so I'm just going to skip through this example on Apple, which was a delta neutral hedge example as well, just a little different way to do it. But again, I'm happy to provide the slides for you guys. But let's look at another real world example. This is one we did fairly recently in October of last year on LabD. Okay, this is I believe a rolling example. So we had set up a bear call credit spread on LabD with an October 20th expiration. That could be done for 20 a contract. So again, we'll use a 10 lot as an example. You collect $200 for putting the position on. Now our goal is to keep that $200 by October 20th. All right. And in order to do that, we need LabD to trade below our spread, which in this case was a 25-27 strike call spread. However, LabD blew right through that 25-27 spread to the upside on October 19th, leaving the position with a potential max loss. Okay, and this is where credit spread traders get themselves into trouble. However, there was a viable adjustment strategy available to us at the time. In this case, it was rolling. So on October 20th, we adjusted the position by rolling for a net credit. So the original position was debited 70 a contract and rolled out for 75. So notice there's that net cash positive component, right? We're debiting 70, rolling the contract out in expiration, same strike price, the 25-27 spread, for a small net credit of 75 a contract. And we did this because LabD traded up into a resistance level, rejected it, and started to rotate lower. So we had a high level of confidence that both implied volatility was going to come down and the share price was going to rotate lower, which is exactly what happened. And on November 3rd, this position could be closed for 25 a contract, turning a potential loss into a net potential profit of 250 per contract. Okay, once again, imagine nothing had gone wrong and LabD just behaved itself and stayed below our 25-27 call spread. Our maximum profit potential on a 10 lot is $200. However, LabD didn't behave itself. It causes some trouble we made one single adjustment and came out with a potential net profitable outcome of greater than what the profit potential was had nothing gone wrong to begin with. Another real world example. Now I'm going to give you some crucial tips for adjusting. So I've given you some different highly effective adjustment techniques for some of the more popular option strategies, but when do we use these? Now, hopefully you can kind of see that the trade adjustments can be both defensive and offensive. The key is we want the trade adjustment to match the strength of the move in the underlying security. We want that to line up with implied volatility, right? So if the market's in a sharp decline, a delta neutral hedge might be the most appropriate adjustment technique, and it can potentially turn a losing trade into a big winner in that case. If the underlying slightly breaches our spread, maybe implied volatility has started to creep up, and we can achieve a net credit by just rolling the position out and waiting for implied volatility to come back down. That can help us ride it out until the trend reverses or implied volatility comes back down. So that might be a more appropriate scenario for a rolling adjustment. But the trick with adjustments is not only knowing how to execute them, but when and what to adjust. So now you know that a high percentage, and in my personal experience, upwards of 75% of the losing trades that I was experiencing can be avoidable. They're fixable. I can mitigate a loss. I can turn it into a break even or even a net profitable outcome. And there's an adjustment to fix virtually every bad trade. We have a lot more of them. And I'll tell you how you can momentarily how you can learn more of our adjustment strategies. Obviously, we have limited time here today, so I wanted to share a couple of our highly effective techniques for some of the more popular option strategies. But I'll again tell you here momentarily how you can learn a lot more adjustments for other option strategies as well. But I've revealed a few of my most effective adjustment techniques to fix losing options trades. Now I want to invite you to learn more and continue on with us and actually see how we do this in real market conditions. So we put together a very special trade alert bundle package exclusively for the Mad Hedge event and members here in attendance today. That includes 12 to 15 alerts per month. So this combines 4 of our top alert strategies, and I'll walk through what those are. And on average, you get 1 new alert per week per service, which have a typical holding period of only about 14 days. So we're selling short dated premium, and a high percent of the time we keep that premium within the 2 weeks and we move on to the next trade. We aim for an average win rate of 85%. We've actually far exceeded that in our premium selling services, but that's our benchmark, where we can actually drop below that into the high 70 percentiles and still have a positive expectancy or the ability to produce a net profit over the long run. But we want to do much better. Obviously, we set the bar high. So we strive for a minimum of 85%. We've actually exceeded that going back 9 years. Again, I need to update this slide. It's now around 380, but we've closed somewhere around 380 winning campaigns in our put writer service. And we have 2 in adjustment currently, which I'm confident will also adjust into profitability, but incredible track record. This is going back to 2016. We actually launched the service in late 2015 with expirations in early 2016. We've never had a losing year in the strategy. Even in the bear market of 2022, we did fewer trades, as you can see, because normally we do about 1 a week, which equates to 50 to 52 per week. We don't force trade, so if market conditions aren't conducive, we may not put out as many alerts. That was the case in 2022. But nevertheless, with virtually the entire market being down in 2022, you wouldn't expect you to have a profitable outcome selling put premium. We did, and I credit that to adjustments. So this is just purely based on a 10 lot. It's all scalable. You can trade fewer or more contracts based on your account size, just your risk tolerance. These are our results from 2023. You can see that every single campaign that we've closed out has been a winner in our put writer service. Pretty incredible. Okay. And actually, I think like somewhere around 95% of these, we didn't even need to make adjustments to, maybe even higher. I think we only had to adjust like 2 of the trades that you see on the screen here from 2023. Sorry, I have to go forward here. Here's what an alert looks like. So you get the annotated chart. You get all the instructions. So you can literally just copy and paste this into your broker platform. This is one that we did on the TLT for over a 19% absolute return annualized out to over 495%. We're also including our equity and ETF service. So if you don't trade options or you trade equities and ETFs in addition to options, you're going to get this service as well. Again, you get the annotated chart, the description. This one was on Morgan Stanley. Days in trade, 13, a 266% annualized return. You get all the exact instructions. Here's an example of one on the triple leverage Qs. This was an it says iron condor. That's a type, which is actually a credit spread. This is a bull put credit spread. $540 credit on a 10 lot, almost a 22% absolute return in only 13 days, annualized out to over 616%. So again, you get the annotated chart, you get the exact instructions for how to enter the trade. You get access to our best trades in real time. So we send these out to you after market hours. You don't have to sit and watch your computer all day. They come out after market hours, so you have ample time to enter these with your broker that afternoon, that evening, or the next morning pre-market. You get the easy to read instructions, including, again, the annotated chart, the order entry screenshots. Trade adjustments are also included. So in any scenario where we encounter a hurdle in any of these trades, we do send out trade adjustments as necessary, okay? But there's more in the package, so I'll go through that here real quick, and then well, if there's time, open it up to questions. So you get an entire year of our top 3 options and our equity and ETF service. That normally would retail for $1,499. You get trade adjustments along with these when required. Normally, our trade adjustment service retails for $299. I'm also throwing in a robust training. Again, we only got to spend about an hour together today. We have a 10-hour course. It's actually a little over 10 hours online. You can watch it at your leisure, that goes into much more detail. Other option strategies, equity strategies, even Forex strategies. We cover different asset classes, different markets. And you get access to that. You can watch it at your leisure. And then we go into trade adjustments. That retails for $997. You're going to get access to our private Facebook group, which retails for $199. We have well over 800 members in our group that also do trade adjustments. You're going to get the bonus trade adjustment training as well, which retails for $900. This goes into depth how to do these different trade adjustments for various option strategies. You don't need to day trade. Again, we send everything out after market hours. Only exception is we may send out an adjustment during regular market hours, but all the new alerts go out after market hours. Again, 12 to 15 per month. We have a guarantee of 80% or greater win rate. Again, we far exceed that, but we do put that in as a guarantee. Ultimately, I'm inviting you to learn to trade equities, ETFs, futures, Forex, options, whatever market is your bread and butter. We cover it all. So I'm inviting you to do that with us and join our team at Altos. So the package we put together exclusively for the Mad Hedge event retails for over $3,800. We're going to slash 85% of that off today only. Okay, so you can get everything you see on the screen, this entire package, for 85% off at only $597. Not only that, you're grandfathered in. Okay, so you'll never pay the full retail price. There are no contracts, no commitments. You can decide if you want to continue after the first year. That's entirely up to you. We don't lock you in. We are limiting this package to 15 members. Which is not to say that you can't still get these things from us when the 15 spots are taken. It will go back to the retail price. So if you want the 85% discount, you'll need to claim one of the 15 membership slots. And you can do that by going to altostrading.com/bundle. I want to thank everybody for being here. I hope you learned a lot today. And I want to welcome everybody who joins us. And I'm excited that you'll learn a lot more as it relates to trade adjustments, option strategies, and how we do things at Altos. I want to thank everybody at Mad Hedge, John and Kate and their whole team, for having me here. John, I'll pass it back to you. If there is any time for questions, I'm happy to take those. If not, let me actually fast forward. We do have a guarantee. If you're not profitable, simply send us a copy of your broker statement. We will refund every penny within the first 30 days. I'll fast forward because I kind of ran out of time here on the rest of my slides to our contact information. There it is. You can email us, support@altostrading.com, or give us a jingle, 800-895-9348. If I am not able to get to all the questions that have come through. John, back to you. Thanks for having me.